Psychologist speaking to a lot of finance people. Not everyone knows the difference between a psychologist, a psychiatrist, psychoanalyst, psychiatric social worker. The Bishop of Stepney said a psychologist was a man who, when he went to a strip show, preferred to look at the audience. This is different from a psychiatrist who's simply a doctor who's afraid of the sight of blood. And a psychoanalyst is somebody who lays you down on a couch in order to help you to stand on your own 2 feet. It'll become apparent in a minute why I'm saying this, because of my psychological background and my honor to work for Stamford Associates. Stamford Associates, there's some of the data, established over 30 years ago, manages a very large sum of money, 40 employees in London, but it has one distinguishing feature. Right from the beginning, the founder, Nathan Gelber, had the insight, the perspicacity, the wisdom to hire psychologists full-time, because the organization believes and can show with considerable evidence that we can find, select, monitor, and assist managers, portfolio managers, who consistently beat the market. We have plenty of evidence for that. The question is what the psychologists do. What is our insight? What is our added value for this whole procedure? Well, essentially, there are 3 stages or 3 factors. The one is the research stage. It takes a very long time and a great deal of effort to find these individuals. We know they are rare, we know they are special, and we know they exist. We've got plenty of evidence for that, who have the ability to run a highly successful portfolio. So there's a great deal of effort, research effort, into searching for these people right around the world. That takes time and takes effort, and there is a psychological component to that. We're, of course, interested in their behavioral output, in the evidence of what they've done in the past for their selection. So we assess, mainly with my analyst colleagues, their record of assessment. And then, of course, there is the whole issue of monitoring their behavior over time. We spend a great deal of effort monitoring our portfolio managers, who I think benefit from the process. And now, as a psychologist, one of the things we know is that there are really 3 or 4 types of data. There's behavioral data, what people do. So behavioral economists are interested in the choices people make. There is also data where they talk about themselves. They will explain why they did something. We know that people aren't always very good at that. We know that we call it impression management or dissimulation, that they don't always tell entirely the truth about what went on. So there's what people do, behavioral data. There's self-report data, what they say. But there's observer data, what other people say about them, the people who they manage, their peers, their analysts, their clients. There is, of course, now considerable interest in physiological data. And it might be in due course that we'll be using MFRI scanning and this sort of thing to help our selection. But we're very aware of when selecting and managing people, we need to look at various types of data. Now, we used to believe in this mythical creature called Homo economicus. And Homo economicus was a wise, perspicacious individual who was cool and rational and made logical decisions. We know that he never existed now. We know that was a charming myth we told ourselves and based some rather interesting models on it. So Homo economicus has died and has gone to heaven, as you can see. And he was replaced by Homo psychologicus. And this was a person who had this bounded rationality. He had 1 or 2 weaknesses, and all that you know, that he would process information in all sorts of ways, which didn't follow the complete logical model. He thought fast rather than slow. But you know, people don't make their decisions sitting in front of a computer screen alone. It's very, very rare that anybody making decisions on behalf of themselves, on behalf of the others, do it alone. They consult other people. They make decisions in groups. They get people feeding them information. So we have Homo sociologicus now, looking at the person and how this little group of individuals, this little group of portfolio managers with their analysts, how that group makes the decisions and how the social factors, as well as the psychological factors, influence their decision making. So the question is, what do the psychologists do? There are three of us now at Stamford, all certified psychologists. What do we do and what do we look for? Well, essentially, we look for three types of skills, three bases of information, three areas of expertise. Psychology is divided into many, many different groupings, and so we look for three in particular. One of which all of you will know about, and so I won't talk much about. We are interested in people's knowledge of behavioral economics, on processing, on what we used to call cognitive psychology, the way in which people choose, make decisions, and indeed rationalize those decisions afterwards. So that for us is a non sequitur, at least not non sequitur, a given. You have to know about that. But we have two other factors, and one relates to what Luba was saying. And that is, we insist that people have a knowledge of organizational psychology. Because portfolio managers do not sit alone in a little office making decisions the whole time. They run groups, they have analysts, sometimes lots of analysts, and they work in teams. And this little grouping forms a corporate culture, some of which are self-evidently pathological, not fit, not healthy. The corporate culture, and you only have to go to an organization for the first time, you need to walk in, and corporate culture hits you. You can taste it. You can see the strange behaviors that people take part in. And what we've noticed when we are monitoring our portfolio managers is that there is a little culture in the office. The way, how many analysts do they have? What's the procedure? How are the analysts rewarded? How does the reward relate to their decision making? Who do they consult with? Do they have somebody to bounce these ideas off? And you'll notice very different patterns with, of course, very different consequences. This is not one individual sitting there processing information. It is often a team effort, quite a big team effort, which has very, very significant consequences. So we require a knowledge of organizational psychology. We also, and this is, I think, one distinguishing feature, and that is we require an interest in differential psychology. Differential psychology is the psychology of individual differences. Cognitive psychologists, behavioral economists, social psychologists ignore individual differences, assuming that everybody processes things in the same way. And it's considered often to be error variance. It's patently not true. It's patently not true. There are significant, important individual differences in the simplest of things, appetite for risk. So I want to talk a little bit about these three areas and how we at Stamford do this. So we reckon that a person's ability and personality determine how they manage each other, how they manage themselves and their staff, but also how they make decisions. And their decision-making style might make them more or less successful. So the model goes, there are individual differences. Some people, we're different one from another on a number of variables, many significantly related to the whole business of portfolio management. I did a big review on the anchoring effect. I'm very interested in this. You know, there's a literature on the anchoring effect, a big literature. My review was about 4 years ago. And of course, there are individual differences. Predictable, reliable, replicable individual differences on why some people are more susceptible to the anchoring effect than others. So we believe that a portfolio manager's personality and ability, I heard some talk earlier of ability, cognitive ability, that these two in combination influence their management style, the style in which they manage each other, and they manage their analysts. Furthermore, it relates to the way they gather information, because information doesn't come at them, although it does, they select it out. They look for information. They could tell others to look for information. And their personality and their philosophy determine that. And furthermore, it also determines on their decision-making style. So what we've done is, and I'm writing a review at the moment, I have found, after some considerable effort, 61 papers in a wide variety of journals, including the Journal of Portfolio Management, but in psychology, on the personality of investment portfolio type managers, and those characteristics which are associated with success and those which are associated with failure. And from this considerable literature review, we've been able to identify, myself and a psychology colleague, 11 factors we think are important in success in this world. Now, it's important to note that we're not looking for linearity, we're looking for curvilinearity, i.e. that you want enough of this factor, not too much or too little. And these are just some of them we've come across. Risk appetite, that's pretty self-evident. But there's also, of course, detail orientation. To what extent do you become OCD and trapped by this on the searching again and again for the minutiae of behavior? You don't want people who are impulsive, you don't want people who are OCD, you want an appropriate level of detail orientation. Curiosity, I think curiosity is the single best predictor of intelligence and staying alive. It's a very attractive characteristic in human beings. I'm interested in their curiosity about all sorts of things. That is a good measure. There are others as well. Quirkiness, adaptability and flexibility, honesty and integrity. And we've got, along this, we have 12 of these characteristics now, and we have ways of assessing people of them. And there's the longer list, if you want. Just look at the second one for a moment. It's very important. It's emotional regulation. We are very interested in when people make decisions that go wrong. And they do. We all make decisions that go wrong. We all buy stocks and shares which don't succeed. The question is how you cope with that. What are your coping mechanisms? Why are organizations so fascinated by resilience and all this stuff at the moment? Because of stress. Because under stress, we know that from Kahneman and Tversky, 1976, that factor influences their decision making. So how people regulate their emotions is fundamentally important. Now, this is a table I've been working on. So we have threat avoidance versus reward seeking, what people have called BIS-BAS theory, but never mind, that some people will be more interested in avoiding failure, others in achieving success, to what extent you're tactical or strategic, data-driven versus intuitive, and autocratic versus democratic. There's lots of data on all this. The point I want to make is that there are systematic individual differences. We can assess, you and me and anybody, on these variables which relate to their investment decisions. Next, there is, of course, the monitoring. We, as part of our service, if you like, we monitor very carefully and very systematically our portfolio managers over periods of time. And this has been going on for years and years and years. It is for them, I think, in some senses a little stressful, but many of them say how much they benefit from it. And what we're after is trying to assess that little group of individuals and what goes on in the office. This is where the organizational psychology comes in. So we're interested in corporate culture. I endorse entirely what Luba said. Very interesting factor, and it's very observable and it's measurable. There's the issue about relationships, the relationships with each other, the relationships with the analysts. I've seen some astonishing managers who are not very good at managing those relationships. They rely on their analysts to give them information, and yet those are very poor relationships. There's awareness of bias. To what extent are they able to articulate? You see in the data their bias. Can they articulate that bias? Do they know? Some of them pretend to know a lot about behavioral economics and trip off all sorts of sexy things. But are they aware of their own particular bias, particularly overconfidence? There are issues around articulating and maintaining conviction and personal style value. We are very interested in a person's philosophy and style. And we are interested in style drift, where they've chosen a particular path and move away from it. Are they cognizant of that? The capacity to monitor their investments. How many investments can you as an individual monitor? And how well do you monitor them? And accountability, etc. So the game is to try and find ways of very carefully assessing the performance of these individuals. Now, this is me just showing off at the end. It's a recent paper I've been trying to do on, it's a published paper on what predicts how wealthy you are. And you can see your intelligence at age 10 predicts your wealth at age 50. And what we hope to do in due course is to be able to build up a data bank like this and it will be longitudinal data, not cross-sectional data, longitudinal data. So you measure people at time 1, you measure all sorts of things, and you can measure them at time 2, time 3, and time 4. And investments are relatively easy to measure. It's money. So to summarize, we believe, I think it's rather odd that our competitors don't use psychologists. I think, I would, wouldn't I, that we bring something to the party, that a psychological insight, particularly the type of psychology we do, helps us significantly in the business of selecting portfolio managers who we can prove beat the market and are highly successful. And the 3 skills are the knowledge of behavioral finance, which people in this room will outperform me considerably, I know that. That is a very important factor, but it's not the only factor, because people don't make decisions on their own. They make decisions in little groups. They select information given to others. They ask others to give them information. That information is given to them in a particular way. We're interested in that little culture. And thirdly, we're interested in, of course, the quirkiness of the individual differences. When you meet successful portfolio managers, they come in very different shapes and sizes. And what we're trying to assess is the extent to which those factors that we think are important play an important part in their ultimate success. Thank you.